Ultimately, the true foundation of America's technological supremacy is not Silicon Valley, Stanford's laboratories, or even its political institutions. While these factors are undeniably important, the most fundamental driver of U.S. technological innovation is the U.S. stock market. We often assume that the stock market thrives because of visionary geniuses like Steve Jobs and Elon Musk. In reality, the inverse is true. It is the U.S. stock market, with its unique mechanism for distributing failure and sharing risk, that mass-produces figures like Jobs and Musk. Innovation is an extraordinarily expensive gamble. Consider Apple's car project. It spanned a decade, employed 2,000 top-tier engineers, and burned through $10 billion before being entirely scrapped in February 2024 without producing a single vehicle. For an ordinary company, a $10 billion loss would trigger bankruptcy 10 times over. Yet, under the U.S. stock market system, this colossal failure is merely a line item in Apple's earnings report. This demonstrates that the barrier to entry for hard tech innovation is so prohibitively high that even corporate giants risk total loss, the globalization of risk, and localization of returns. So, who pays for these exorbitant failures? The answer is both simple and harsh: global investors. This is the unparalleled magic of the U.S. stock market. It successfully globalizes risk, while keeping the returns localized. Consider the major shareholders behind tech titans like Apple, Microsoft, and Nvidia. They include Japan's pension funds, Norway's sovereign wealth fund, Saudi Petrodos, and everyday retail investors buying Nasdaq index funds. The underlying logic is crucial. When Apple's $10 billion evaporated, that money was genuinely lost from the perspective of ordinary investors. However, the capital did not vanish. It simply changed hands. As the $10 billion was burned, it was converted into the lucrative salaries of 2,000 elite Silicon Valley engineers and the income taxes they paid. It flowed into California's real estate market, consumer spending, and payments for precision manufacturing equipment. Even if those engineers eventually left Apple, they took their decade of acquired expertise to other American companies, continuing to build the edifice of U.S. technology. In essence, global capital is indiscriminately subsidizing America's innovation capacity regardless of the cost. This dynamic reveals why the United States will protect its financial system at all costs. The U.S. maintains its long-term global lead because this financial architecture translates technological success into unshakable economic moats and geopolitical leverage. Giants like Microsoft, Google, and Amazon are not merely top companies by market capitalization. They own the economic infrastructure of the modern era. Technological supremacy directly empowers national security and diplomacy. Competition between nations is fundamentally competition between their leading enterprises. The nation with the most top-tier companies secures the strongest structural support. This corporate dominance also helps the U.S. absorb and resolve systemic issues like national debt and excessive money printing, either by digesting them through productivity gains or by triggering destructive forces elsewhere. The U.S. protects its financial system not just to defend specific stock indices, but to secure global monopoly and pricing power for the next 50 years. The rational calculus of global capital. Why would global investors willingly throw their money into this high-risk incinerator? Capital is never stupid, it is hyper-rational. Global investors willingly pour funds into the U.S. because they have carefully calculated two key factors. The first is the mathematics of probability. According to the Wall Street Journal, 3/4 of startups will fail. However, successfully backing the remaining 1/4 can yield returns of 100 or 1,000 times the initial investment. If you invested in Nvidia a decade ago, you hardly care about the numerous other startups that collapsed along the way. The U.S. stock market sells this compelling narrative to global capital, and more importantly, it actually delivers on these massive wealth creation myths. It tells the world, if you are willing to pay for our failures, we will let you share in our spectacular successes. This allure acts like a magnet for global wealth, drawing investors eager to gamble for explosive returns, when true innovation creates market monopolies. The second calculation revolves around legal and judicial certainty. Warren Buffett achieved legendary status primarily because his battleground is the largest and most regulated market in the world, the U.S. stock market. If he operated in environments like Zimbabwe or Venezuela, currency devaluation and a lack of the rule of law would have easily raised his fortunes. This highlights the second core reason global capital chooses US equities. You might lose your money to a failed road project, but it is highly unlikely you will lose it to a scam. If a US-listed company fabricates its financial data, it faces a relentless onslaught, not just from former regulators, but from countless market participants actively looking to expose fraud for profit. This greed-driven oversight is often more ruthless and effective than administrative mandates, forcing the vast majority of companies to operate honestly. Capital despises uncertainty. While technological failure is a calculated risk, financial fraud is an uncontrollable variable. By providing a clean casino with guaranteed fair rules, the US ensures that winning or losing comes down strictly to investor vision and luck. This is why Buffett famously remarked at the 2025 shareholder meeting that America is both a grand casino and a grand cathedral. Dollar hegemony and externalizing crisis. The US financial system is often characterized as a hegemony because it strikes at rival nations mercilessly while sparing no effort to shield itself. This dual nature explains why the US stock market can crash, yet consistently and rapidly achieve a full recovery. The secret behind this resilience is the dollar tide. When the market collapses and systemic credit is threatened, the Federal Reserve's response is decisive and aggressive. It implements quantitative easing, QE, and fires up the printing presses, not fundamentally to bail out Wall Street, but to salvage the credit of the entire system. This massive injection of dollars establishes a floor for asset prices, creating the prime condition for a rapid recovery. But who pays for this limitless money printing? This is the most ruthless aspect of American self-preservation. The bill is footed by everyone worldwide who holds US dollars. The Federal Reserve rescues domestic financial markets by printing money, which directly dilutes the purchasing power of the dollar. This represents the externalization of crisis costs. Leveraging the unique privilege of the dollar system, the US transforms a domestic crisis into global inflation. The influx of immense liquidity, combined with America's unyielding innovative engine, drives the stock market to new record highs. Systemic credit is preserved, but the inflationary price tag is distributed globally. In short, when America gets sick, the world is forced to take the medicine. Furthermore, after implementing QE to rescue the economy, the Fed inevitably begins quantitative tightening. QT, to shrink its rapidly expanded balance sheet. QT is an incredibly destructive financial weapon, arguably more lethal than raising interest rates. While rate hikes merely increase the cost of capital, QT actively drains liquidity from the market. When global liquidity contracts significantly, it frequently triggers debt and economic crises in other nations. The US can then leverage these foreign crises to PE